Welcome back to Squawk on the Street. Time now for our ETF Spotlight. Mike Santoli's back, taking a look at financials falling deeper into bear market territory. Hey, Mike.
Yeah, Carl, that's right. I mean, the overall sector down more than 20% from its earlier highs. If you look on a year-to-date basis, XLF down more than 13-14%. Look at the different slices of the financial sector. The KCE is one that I like to watch. It's the capital markets ETF, asset managers, investment banks, things like that. They've obviously been hurt a lot from the highs, but the banks, the pure banks, are also really right at the center of all this. I think this sell-off has gone beyond trying to explain it with, oh, it's a flat yield curve. It's going to be a little bit of a slowdown next year in terms of the overall economy, into asking what else might the performance of the banks right now be telling us about the broader macro environment, whether it's some kind of credit stress, concerns about corporate loans. I think all of that is feeding in right now. Also, though, late in the year, tax loss selling, you're hearing people say they still look cheap, but just unwilling to find a positive catalyst. I do think we're now also in the zone of saying, have investors capitulated? So look at this chart. It shows the flows into and out of the XLF, the broad S&P Spider financial sector ETF. This is from Renaissance Macro research, showing that we've dipped into a heavy liquidation phase. Don't worry about the numbers on the left. It basically shows you lots of money coming out of this ETF, similar to previous periods when you've seen the XLF get very oversold and maybe at some point setting up for a buy. And this is really what the overall market reflects too. The market's been so relentless in this downtrend, we're starting to ask, are people kind of overdoing it sentiment-wise and flow-wise on the downside? But so far, not a lot of relief either with the sector or the broad market, guys.
With breaking news. Welcome back to Squawk on the Street. I'm Diana Olick with breaking news. Homebuilder sentiment dropped 4 points in December to 56, the lowest level since May of 2015, and a steep drop from 74 just 1 year ago. This according to the National Association of Homebuilders Wells Fargo Housing Market Index. Anything above 50 is considered positive sentiment, but this is a big miss. The Street was looking for a slight gain. It's all about affordability. Even though mortgage rates pulled back slightly in the past few weeks, NAHB Chairman Randy Knoll said in the release, we are hearing from builders that consumer demand exists, but that customers are hesitating to make a purchase because of rising home costs. Of the index's three components, current sales conditions fell 6 points to 61. Sales expectations in the next 6 months dropped 4 points to 61. And buyer traffic fell 2 points to 43. Regionally, on a 3-month average, builder sentiment in the Midwest dropped 2 points to 55. The West and South both fell 3 points to 68 and 65 respectively, and the Northeast plunged 8 points to 50.
That further demonstrate that the housing market is slowing down came out today. Diana Olick has the details. Hi, Di.
Hi, Ty. Yeah, it really appears to be jamming on the brakes. Several new reports pointing to a sharp drop in demand. First, mortgage applications to purchase a newly built home fell 5% annually in November, according to the Mortgage Bankers Association. Now, this is a pretty big drop to begin with, but it coincided with a big drop in mortgage rates, which should have spurred home buying. Rates dropped from over 5% at the start of November to around 4.85% at the end, that according to Mortgage News Daily. The problem, though, is still price. Too high. Prices ran up because of very tight supply, but supply actually jumped 5% in November compared to a year ago, which is the fastest growth in 3 years, according to Redfin. Still, Redfin saw sales drop 8% in the markets it covers. Now, one striking example, Las Vegas, which had been a very hot housing market just 6 months ago. The inventory of homes for sale in November there was up 54% from a year ago, and sales were down nearly 12%, that according to the local Realtors Association. Now, the increase in supply and drop in demand has, of course, led to fewer bidding wars. A year ago, 45% of listings on Redfin were getting multiple offers. Today, just 32%.